It's an honor to introduce my friend and Tom Curry's friend, Andy Calamare. Andy Calamare, to my left here, is also the former Commissioner of Banks in Massachusetts. He's currently Executive Vice President of the Co-operative Central Bank. Now, that's not to be confused with the Federal Reserve System. It's the Massachusetts Co-operative Central Bank. I serve on the board of the Federal Home Loan Bank of Boston, where he is our chairman. And by the way, the Federal Home Loan Bank of Boston is co-sponsoring the reception after this event, so I hope as many of you as possible will hang around for that. Andy, it's all yours.
Thank you, Professor. You've been called worse, I know. Exactly. It's a pleasure to be here this afternoon. We've got a great, distinguished panel this afternoon to talk about issues affecting banks in the future. Their bios are in your package. We're not going to spend a lot of time on biographies, although Cam and I both served as agency heads in state government, and we both decided that we're going to go back for a couple of weeks just to settle some old scores, issue a few subpoenas, and then come back. Right, Cam? Right. So, as you see in your bios, Cam Fine is the president and CEO of the ICBA, former community banker himself, chartered a bank, knows what it's like to work in a bank. Karen Shaw Petrou is a managing partner of Federal Financial Analytics. She's at the forefront of most banking analytical questions in the last, I won't say how many decades, I'll leave that to go, but I go back farther than you, Karen, but you certainly are at the front line. And also we have the Honorable Sharon Bowles, a member of the European Parliament, who is the chair, I want to get this right, Sharon, the chair of the influential Economic and Monetary Affairs Committee, which is guiding the European Parliament as it formulates uniform and consistent rules for the European Union. So we're delighted to have you all here. We're going to start with Cam Fine, who will talk about the future of community banking. Karen Shaw Petrou will then talk about intermediation. And then we'll end with the Right Honorable Sharon Bowles. You're not the Right Honorable? The Honorable Sharon Bowles, who will give us a little perspective on what she's doing across the pond. Cam?
Thank you. I wish I had that cool British accent, though. That'll really be neat when she gets up to speak, and words like rubbish and things like that. I love that stuff. I want to thank the Comptroller. Happy birthday, even though you were born in the Civil War, kind of inauspicious occasion, but nevertheless, wonderful job you and your staff are doing. And I want to thank Boston University and Con, thank you so much for having me here today. I painstakingly wrote out a 15 or 20, probably a 20-minute speech that I'm not going to give, because I don't like to read speeches. That's just not me. I feel too much like a regulator when I do that. And if, and the regulators and I have a checkered history, even though I was one at one time, but I was a tax regulator. I was the director of the tax department in the state of Missouri. And if you come from a state that's 2/3 Ozarks, you don't want to be the tax director. Let me tell you that. There are some counties in southern Missouri where they're still minting their own money. They don't recognize county government, much less state or federal government. So you have to understand the culture of our state. But I live in Washington now, which makes those folks that mint their own money look mild compared to some of the people in Washington. I thought I'd seen it all till I moved to Washington, and it's a different culture than the Midwest, let me tell you. I have a passion for community banks. I chartered a bank. I then went out and bought a bank. That used to flummox some of my mega bank friends. They'd say, well, who owns the bank? And I'd say, I own the bank. Well, who are your shareholders? Me. And I had one senior banker from a huge, giant bank that unfortunately didn't make it through the crisis say to me, well, how do you do your board meetings? And I said, well, after supper, my wife and I are eating apple pie and drinking coffee and talking about the bank. That's a board meeting. And it just totally flummoxed him. He couldn't figure that out. there's not a great appreciation for privately owned banks in this country, but ladies and gentlemen, there are about probably 5,500 or more privately owned banks in this country, and a huge portion of those are owned, like mine was, by one single family. And they're sort of under the radar. You don't even see them, but they're there, believe me. I'm tasked with talking about the future of community banking. And those of you that ascribe to the Big Bang Theory, well, if there is another Big Bang, you know, sometimes you hear people say that the only thing that will survive the next Big Bang are the roaches. Well, actually, two things will survive: the roaches and the community banks. They'll both survive. Policymakers, regulators, presidents have been trying to do away with community banks for 200 years, and they just keep surviving. They just won't go away. And if you really delve down into the history of the Currency Act, one of the objectives was to have just a national banking system, no state banking system. They thought they'd eliminate the state banks. Surprise, they survived, and that's what they will continue to do. Community banks have a very bright future. They have a symbiotic relationship with their communities. They have flat management structures, they're nimble, they're innovative, they develop innovative products. Believe it or not, most community banks are very technologically savvy. It would surprise you. And they also appeal to Gen Y. They appeal to the Generation Y because they're relationship bankers. And Gen Yers crave good relationships. Gen Yers might be tech dependent, but they still like relationships, and that's important. So community banks are prolific small business lenders. Even though they only control 19% of the assets of this nation, they make 60% of the small business loans of this country. And small business creates jobs. 2/3 of the jobs created in this nation over the last 15 years have been by small businesses. So you have that relationship going. Community banks don't get bailouts. Community banks sometimes have trouble raising bail. That's what we worry about, is we worry about being able to raise bail, much less getting a bailout. So we have two twin challenges to that bright future. Asset concentration is one of the challenges, and regulatory burden is the other twin challenge that could be a problem for community banks going forward if we don't overcome those challenges, but we will. How does asset concentration and regulatory burden manifest themselves? Well, first, systemic risk. You've heard all of that. Systemic risk. Right now, just 6 banks out of 6,600 banks, just 6 now control over 50% of this nation's banking assets and this nation's deposits. Just 6 banks, okay? Market advantages. There are dozens of studies that talk about the market advantages. The IMF, $70 billion a year advantage. The New York Federal Reserve Bank, 41 basis point funding advantage. They have capital advantages. You all know all about the advantages. Lack of diversity. Lack of diversity. The FDIC did a study. It shows that of the 3,200 counties in this nation, 1,200 of those counties, roughly 1 in 3 counties, is only served by a community bank. That's the only source of commercial banking services to the citizens of those counties. If you add up the populations of those counties, it's just short of 20 million people. The only physical presence in that county is a community bank. So asset concentration is a driver of consolidation and thus diminishes access to banking services for millions of Americans, those Americans in those 1,200 counties. Asset concentration taken to an extreme destroys free market system, our free market capitalist system, is based on competition and diversity. If you take asset concentration to the extreme, there is no diversity. You become a cyclops. We have a cycloptic banking system, one giant eye just stomping around. That doesn't promote diversity. Right now, we have an oligopoly. We're headed to a monopoly. And how does that encourage competition and diversity? Short answer, it doesn't. I want to say something about Khan's subsidy reserve bill, H.R. 2266. It's an interesting way to approach this problem of asset concentration. At least they have to acknowledge it on their balance sheet. And ICBA supports that. We think we have to get our arms around this asset concentration problem. But that's just one problem. The flip side of that same coin is regulatory burden. Regulatory burden is a byproduct of asset concentration. And why do I say that? Because if you look at every single major financial piece of legislation that has gone through Congress since the late 1970s, dealing with some aspect of regulation, it has been triggered by a major bank. It has been triggered by something that happened that the Congress and the regulators want to correct at a major bank, and then it tumbles down on us. It's indiscriminate. Bank regulation is indiscriminate. It's blind to the size of the bank. So in my little bank in Jefferson City, Missouri, which was a $50 million bank, I have to fill out the same 80-page call report that Citi has to fill out. I have to have on my shelf many of the same policies that Bank of America has, even though I don't engage in that stuff. It's indiscriminate, and it is choking community banks to death. Regulatory burden chokes off credit. Regulatory burden stymies the relationship model. Community banks are built on the relationship banking model, one-on-one. I sat out in my lobby, my desk. I had a desk, even though I owned the bank and I was the president. I could always go into an office if I wanted to, but I sat out in the lobby. And I saw every customer that came into that bank. I knew them all. It's a relationship business. And regulation squeezes the relationship out of banking. You're put into a process. It becomes a process. Judgment and relationship are squeezed out. And that's death to a community bank. It is the relationship that is the key to the competitive edge that community banks can have. And it stifles innovation. Community bankers are very reticent to develop something new for fear that they're going to go on the wrong side of some regulation. When I got into banking, Tom, you'll probably remember this, the call report, the quarterly call report, when I got into banking, my very first call report that I ever had to fill out in 1984 was 14 pages long. And I could fill it out at my desk, took me maybe a half an hour, and then I'd file it. Today, the call report, this one that's coming up today, as a matter of fact, March 31st, that call report is 72 pages long, and it's going longer here in the near future. It'll probably get up around 80 pages long, 4 times a year. Now, if you still have thousands of community banks that are under $250 million in asset size, and they're having to file 320 pages a year, roughly 80 per quarter, to the regulators. That's time-consuming, it's burdensome. There's got to be a better way. There's got to be a better way. So taken together, those twin challenges of asset concentration and regulatory burden, which is many times born out of the mega bank culture, those need to be overcome, and then we have a bright future. But don't misunderstand me. Community banks will survive. They are survivors. They've survived every crisis, and they'll survive every crisis in the future because we're Americans, we're entrepreneurial. You get a few people together, they pass a hat, they raise capital. Oh, that's another gripe that I have, by the way, is that we we need to loosen up on de novo. So there's a lot of people that want to create banks out there, but the de novo process is broken, and we got to fix it again. So just a word to the wise, you're going to be hearing more about that. There are people that want to start banks, so let them start the banks, and let's get it going again. Thank you very much.
Cam, as usual. We're next going to hear from Karen Petrou, who's going to talk a little bit about intermediation and other matters. Karen?
Thank you very much, and I'm going to stay put, not only because if I go to the podium, she's going to take all the attention, but because I didn't wear pockets and I'm going to drop my mic. And thanks again to Con and to all of you for inviting me here. This has been a fascinating conference, and I just want to say, Con, I do think your idea of keeping this going and reviewing how the policy discussions everybody is talking about are faring, and holding another meeting like this next year would be a great contribution, and I really hope you do it, and I'm sure all of you do as well. The topic that Con has asked me to talk about, as Andy has said, is financial intermediation, the future thereof. And when I think about it, really takes me right into this question of shadow banking. And I know there was discussion about that this morning at a couple of different panels. But often when we think about shadow finance, it's put into the wholesale context of products like securities financing, repurchase agreement, money market funds, asset securitization, not the traditional financial intermediation process. And what I'm going to try to discuss today is, sorry, she disagrees. What I'm going to try to discuss today is how the shadows and what they are, less or unregulated financial institutions, are playing an ever greater and indeed often exponentially greater role in certain business lines that are key to financial intermediation, and therefore cut across the spectrum of CAM's community banks and the very largest global and US financial services firms. Just a couple of facts to make clear why I think this is important. The most recent survey from the Financial Stability Board, which is the overarching agency for global banking, securities, and insurance regulators, a couple of weeks ago calculated shadow banking at a global $71.2 trillion number, which is big. And it's even bigger when you think about the fact that they leave out a lot. They leave out many retail services, retail payments, mortgage finance, small business, corporate finance that in the US and in other parts of the world are quickly redefining themselves. So I think that $71.2 trillion number is low. But even if it isn't, the FSB also finds that shadow finance equals 174% in assets of US banks. There is a very big market presence here, even as measured by those data, let alone what I think it really is. So it's a clear issue for the industry, and I think it's also a major one for the regulators and for the OCC. From a regulatory perspective, I think we need to think about our current approach, which is, I'll call it regulation by charter. If you're a bank, that rule book Cam talked about gets thrown at you. And the systemic rule book gets thrown at bank holding companies with over $50 billion in assets, even though I think it's silly. Those banks, the smaller edge of that spectrum, are not systemic. And indeed, they're very much closer to Cam's community bank model, let alone to the global systemically important banks. Conversely, if you're a non-bank, even if you are directly engaging in the financial services that are regulated, capitalized, subject to liquidity and resolution requirements at a bank, you have none of those requirements. Now, that's been true for a long time in key bits and pieces of finance, but the banking industry got something in return for all its rules. It got monopoly charters. Because of the rapid increase in financial intermediation, especially in deposit, what I would call deposit taking, that monopoly franchise model is broken. And so the regulation by charter model really encourages what we call regulatory arbitrage. When the economics of a business are driven by regulation, profitable activities will go where the rules are less, even if the risk is the same. So what I would recommend instead is a regulation by function model. And I'll try to talk a little bit later on about how that can be done under current law. We heard Senator Dodd and Representative Frank make clear that new law isn't going to happen. But there is a key piece, a little noticed part of the Dodd-Frank Act that puts a tool right now into the hands of US regulators that would, I think, permit rapid growth of the regulation by function model. For financial services firms, this is a really critical issue because with the end of that monopoly franchise, the bank being the only place that could gather insured deposits and deposits being the only liability product, funding product that customers large and small wanted, has come a significant threat. In our practice, we do regulatory strategic landscapes, and what we are often asked to do is look at a particular business line at a bank, usually a large one, and model it out to see how, holding all things equal, which is hard to do, what are the economics of the business under the bank's model and under the non-bank model without the rules? Where will the business go? And we try in doing this to look not just at the current rule book, but also at the prospective one and the policy framework. And when you do this, you see across the spectrum a dramatic shift in business. Some of this is obvious in key business lines like mortgages, where the business is really redefining itself overnight, in part because of the capital treatment of mortgage servicing rights. In other areas, it's a combination of rules and technology, which we see particularly in the retail payment side. Let me be clear, I don't think the rule book is wrong. I am not in any way saying that the capital rules for MSRs are too tight or that the changes in the bank regulatory model, particularly for the systemic institutions, are right or wrong. With a business planning hat on, I'm saying what I think they are in terms of competitiveness drivers and a real redefinition of comparative advantage in the US financial system. Now with Sharon here, I think I should mention we are taking a very different approach to shadow banking. Because of our charter functional regulatory framework, we talk a lot about it, but we're doing very little other than trying to build out the big bank regulatory framework. And in one limited case, money market funds perhaps address some of those risks through potential SEC regulation. The European system, which Sharon, of course, knows far more about than I, has a much different approach. They do two things. One, key rules, like the Basel III rules, apply across the spectrum of banks, broker-dealers, and investment managers, so that we don't have the pockets of opportunity where if you do the same business, like a corporate loan in a bank, or if you do it in a broker-dealer or a hedge fund, it's easy to get away from the rules. I think that's an important difference. Interestingly, the EU is also focusing on shadow banking in two emerging policy initiatives. One is an effort to choke off the interfaces between banking and shadow banking by curtailing linkages within the system, particularly in the wholesale financial markets. That number I gave you, about 174% of US shadow assets versus bank assets, is 52% in the EU. So you can see that the EU is a far more bank-centric system, and one that might be able to throttle shadow banks, albeit at the cost of far greater concentration in the hands of banks and I think greater systemic risk. There are pluses and minuses on each side of this, as the EU case makes clear. So even then, I think this effort of barring banks and shadow banks from integrating will work much less well than a functional regulatory framework, where activities are defined, risks are identified, and regulation and resolution applies across the spectrum. In our framework, Dodd-Frank, it's critical to build out an orderly liquidation process that ends expectations of too big to fail. I think we're in many ways at the riskiest place we could be in the financial system right now, because the law is as robust as Chairman Frank made clear. It would be a felony to bail out banks anymore, and I do not believe that US regulators will willfully disregard the law. If there is a crisis, they will not step in. But the markets still expect them to. So we have a great deal of moral hazard left in the system, and I think that puts us at acute risk. And it's not just in banks. We need to look at resolution across the framework of banking, broker-dealers, financial market infrastructure, and critically, people who hold other people's money. Because the risks are very different in asset management than they are in banking, but I do not think they are negligible. When you take that down to the bottom line and you look at certain key products, retail payments, combination there of rules and computers, smartphones, all of the new technology is rapidly leading to redefinition. I know Cam talked about how Gen Yers like relationships, but I think they love their phones better. I don't want to go there. This is Surveys show that most millennials would rather do business with Google and Apple are going to be more than happy to do business with them. PayPal is doing small business lending. P2P lending is becoming an increasing factor. Crowdsourced funding for small business lending. Major emerging issues that are still small pieces of the market, but taking profitable edges and showing considerable potential. In corporate finance, at the biggest end, you've got the hedge funds, the private equity funds like Carlyle and Apollo. Apollo has a book of $100 billion worth of corporate finance. And I don't even want to guess how much capital it holds against that $100 billion, but it's not much. Major players in, again, particularly attractive segments of the market that were once traditional banking. So what to do about that? Move away from regulation by charter to regulate by function. And you can do that under Section 120 of the Dodd-Frank Act, which gives the SOC authority to designate activities or practices not only that are systemic, but also that pose risk to vulnerable consumers or investors. Because we have the same issue. Although the CFPB has power across the spectrum, there's of many financial services firms, it doesn't matter to the consumer if the house is lost, if the lender is a bank or a non-bank, if the payment transferred on a new payment system is through a bank or Apple, the money is gone, and we need to have rules that protect customers as well as the financial system. Now, FSOC can't order the primary regulator to implement its rules, but I think it could do a far better job than it has done, identifying systemic activities and practices, looking out to the future, laying these out in regulatory frameworks, and then calling on the primary regulators and the market to regulate itself. It's early days yet, and I know that many of the shadow banking products I've talked about are still seen as marginal. But on a business planning basis, as I said, they can be significant in key sectors and from a profit perspective. We've seen IBM, companies like that, giants, colossi in the US manufacturing and corporate sector, brought low remarkably fast by upstarts like Apple. And I didn't see any reason to expect that finance is any more invincible. I think these shadow issues are very significant, and if policymakers wait too long to recraft the regulatory framework from a charter to one based on function, they will have waited too long, and we'll have a new set of risks in a financial system we're only just beginning to see emerging now. Thank you very much.
Thank you, Karen. We'll next hear from Sharon Bowles.
No.
Thank you. I'll stand. It's easier to juggle with pieces of paper. I've been making copious notes of what to say, so I hope you're all fixed to about 8 o'clock tonight. First of all, thank you very much for inviting me. It's good to be here, and it's nice to be somewhere other than DC when I come to the States. The first thing I thought I'd do is a little bit of scene setting. First of all, although the EU does have a big problem with concentration in terms of market share held by its large banks, it's not that we only have a handful of banks. In 2010, we actually had 10,192 in the EU. That's down to around 8,000 now, with about 6,000 within the Eurozone. That reduction was not really by banks closing, as has happened in the States. It's been more by their community banks, in fact, having to be taken over and forced into mergers. For example, the Spanish Cajas, where we found that we had community banks with very similar business models that were in a kind of broad interrelationship with one another, and so we found we had systemic clusters happening in Spain. And of course, it's also worth noting that the first banking problem in the UK was with a narrow bank, Northern Rock, a mortgage bank. It wasn't with one of the large broker-dealer banks, although, of course, they got in on the act later. Another, I suppose, scene-setting thing about the EU is that when we do legislation, because we're not one country and we're operating under a treaty, we, the legislators, that's sort of me in the Parliament and our second chamber, which is the finance ministers, and there are two chambers, it's not just the finance ministers that agree. If we don't agree, it doesn't happen. We have to actually agree a lot more, and so we're well into the detail of what happens within the regulatory authorities here in the United States. Now, broadly speaking, we're all tackling the same problems. For banking, we've got Basel, we've had some coordination for some time. We adapt that to our smaller banks in a proportional way, but they all come under the Basel proposals. We have a problem with mortgages in the sense that all the mortgages are in our banks, a lot of them actually with the big banks that are also broker-dealers. And the mortgages, and even when there are covered bonds for mortgages, has a serious impact on the leverage ratio. We heard earlier a recommendation that look at the Danish mortgage banks. Well, I tell you, you'd be very frightened if you saw the leverage ratios and treated them as a normal bank, but they have been stable for 200 years. Also, take care with the term covered bonds. There are some very good ones for mortgages, like in Denmark. There are some very good German ones that cover all kinds of corporate loans, and there are some that are full of rubbish, just like any old other asset-backed security. So we're having trouble trying to get a definition of covered bonds, and we're working on it. There is also a problem that they sell them from one bank to another, so that has an impact on large exposures, and it also has an impact on the level of asset encumbrance in a bank. So, you know, there are knock-on effects. Now, in markets, it's harder to coordinate, I think partly because some of it, like derivatives, is newer, markets are more diverse. I think in some respects, the US has much bigger capital markets and is well placed for those to actually provide a better alternative source of funding than the banks. In Europe, everything revolves around the banks. It's loans rather than corporate bonds. The asset management is in the banks. The interactions with the markets are different in Europe. So same rules actually gives different outcomes. And therefore, we need to have a look at the interaction with the markets also when we're doing banking rules, because otherwise you sometimes get funny results, as in credit valuation adjustments in the absence of having a credit default swap market. Now, the problem with having all of this stuff in the banks is that our banks are many times GDP. Well, not many, but several times GDP. So they are all the more systemic when there is a problem. And so maybe that is also why in Europe there tends to be what I would call social security for banks rather than letting them go into liquidation. We also do have this problem that we've got a single currency that is not a single currency in the same way that the dollar is, and that adds another dimension of interconnection. So looking at the Eurozone, we had a spread of the financial crisis into a sovereign debt and an economic crisis that exposed the flaws in our imperfect monetary union, as well as in banking and lack of fiscal discipline. So as the euro runs on rules and not on a mutualised system, all of those issues, sovereign banks and fiscal discipline, all had to be dealt with all at once. One of the ways to stabilise the euro was to try and separate sovereigns and banks, and alongside that, to stabilise sovereigns by tighter fiscal discipline and coordination of budgets. So that means on financial supervision, we have a combination of EU-wide rules plus some special Eurozone extras, which we call banking union. And then on the economic governance side, as we call it, we've got lots of new rules to stop countries behaving badly, with budgetary coordination and discipline aimed at making sure we have much better fiscal control. And again, with stronger measures for the Eurozone in terms of fines and discipline and other things. So altogether, with statistics and other things thrown in for good measure, my committee has done 64 legislative acts. And if you want to know more about them, well, you'll have to go to my website. But some of the common features with those discussed today is, yes, banks are special, and in the EU, we're, as I said, much more in their power without capital markets of significance to take the load. We are also dealing with structural separations, although ours aren't as strict as the Volcker rule, in that activities can still go on in the group, and we're having ring fences. I've actually just been wondering to myself today why we haven't taken bolder rules to say, well, actually, we'd like the asset management to be outside of the bank so we can start to build proper capital markets, and maybe we should have suggested a structural separation between asset managers and banks. So I might go and frighten the finance ministers when I get to Athens, having left here. Now, on shadow banking, we do already have more comprehensive regulation, partly because some of the stuff's in the bank, also because we have regulation of funds through our UCITS regulation for fund management and the Alternative Investment Fund Managers Directive, that hated AIFMD, to do with hedge funds and private equity. Also, when we were transposing Basel III into our Capital Requirements Directive version 4, I decided that quite a lot of shadow banking activity has one leg in the bank. So I thought, well, a good place to grab that is in the banking regulations. So we've made an attempt at that, in particular with regard to disclosure of things like asset encumbrance, repos, and various other reporting requirements, which are now going to be built on as well in a separate piece of legislation. Now, we also have no common bankruptcy law in the EU, so we've passed our resolution and recovery proposals, where we have legislated for bail-in. So now, after using up all of the equity, there has to be at least 8% of bail-inable assets. Now, there's only 3 European banks in the crisis that would have eaten their way through the levels of capital plus 8% bail-in, and the combined sort of buffering effect of that there is. We've also put a limit on how much more you can, if you do then go to funds or the state, you can only go for a further 5%, because we reckon after that it should be being wound up. If you can't rescue it by the time you've got up to about 25% of assets, then what are you doing trying to rescue it? We've legislated for an ex-ante bank-funded resolution fund that's 1% of covered deposits. That has to be built up over time, so it may take a little while to get there. And as part of the banking union, the Eurozone fund gets pooled. Now, the pay into that is all banks. That is absolutely all banks. It's based on size and risk. there's still a little bit of fighting going on as to exactly how that's to be defined in a subsequent rulemaking process. Now, I'll just finish off, I think, with a couple of words about banking union. This is for the 18 countries that are within the Eurozone. So we've made the European Central Bank as the supervisor. It will directly supervise the largest 130 banks, and then it can call up any of the other 6,000 or so banks if it suspects there's a problem. The whole of the EU, that is all 28 member states, have the same regulations and rules for bank supervision from the European supervisory agencies, but the Eurozone, the ECB, will make a further detailed handbook of supervision of its own. But one suspects, well, in fact, the European Banking Authority is also charged with looking at that handbook and the other handbooks that, say, the UK uses to make sure that, again, these are coherent, so we don't have different things going on whether you're in or outside of the banking union. All EU countries have their own pre-funded deposit guarantee scheme. We did have attempts to mutualise that within the Eurozone. That has failed at the moment, but it's been concluded that that does not matter because we have a common level of insurance and common system of rules, and it's all pre-funded, so the money is there. When I say pre-funded, it will be when they've finished paying in. We've also created a resolution authority for the Eurozone so that all of the resolutions will be done in a uniform way. The Parliament pushed us very hard to make sure this is what we call country blind, so that it all depends upon the bank and the risk and all those kinds of things, and not, well, oh, that came from country X and we're not very happy with you at the moment because you've been naughty somewhere else. I think a point on the side to mention is that whilst we've been trying to do this business of separating sovereigns from banks, issues about bank liquidity and reliance on sovereigns have weighed very heavily on our minds in the Parliament. And I did go sort of a bit cross at Mario Draghi whilst he was still head of the FSB when they suggested only sovereigns could be liquid assets. I said, well, that's just what we want in the middle of a sovereign debt crisis to help separate our banks. So he did say, yes, Sharon, I've heard what you're saying. And so we, again, in our Capital Requirements Directive, have stretched the boundaries of what counts as liquid instruments, because the last thing we want to do is to reconnect back to the sovereigns from the banks. It's going to be difficult to sever that because there is so much sovereign debt around and it happens to be residing there. I was going to say something about globalisation, which was the nature of this, but I think perhaps there isn't time. But I'd just like to point out that a lot of our banking regulation is doing the opposite of allowing globalisation in the trade sense, whether that's what the Basel Committee did on trade finance, though I'm happy to say the governors have taken Europe's and my advice, and I did do some pestering, and they've amended that. We have problems now with correspondent banking, not just because of the closure of correspondent banking arrangements because of money laundering concerns, but also the treatment where it might get 100% runoff in the liquidity coverage ratio when quite a lot of correspondent banking is actually operational banking and should qualify for less. So hope you're listening. Then there's a problem with derivatives and clearing, which tends to, and CCPs, and Europe's done a little bit of muck up on this, not my fault, it was all the Commission. And this means that, again, we are shutting out emerging markets and making trade much more expensive for them. And then finally, UK and US are leading the way in ring-fencing capital and liquidity within subsidiaries, which is probably leading to a fragmentation of banking, although you can make justifications for it, and that's a debate all on its own. So there's quite a lot going on, but basically we're all tackling the same problems, albeit within slightly different legal systems and circumstances. Thank you.
Thank you very much, Sharon. we realize that the only thing standing between you and cocktails is question time. So we're just going to ask a few questions and take some from the audience, if that's all right with you. First of all, Cam, I, like you, are a big supporter of community banks, but what do you say to the member bank of your association, who's a $150 million bank, who thinks he's totally overwhelmed by Dodd-Frank compliance? He's not making any money with interest rates the way they are. How do you tell him to hang in?
Actually, I think community banking is at the dawn of probably the greatest period in its history. You know, listen, when I was running my bank during the S&L crisis, the world was falling apart. In 1 year, you had over 700 banks failed in 1 year. We didn't even approach 500 banks in 5 years in this crisis, but 700 in 1 year. And so FIDESIA was passed, FIREA was passed, and the gurus and the consultants were out there saying, this is the end of life as we know it. There'll be no community banks left by 1995. I went to seminars like that, and I was sitting there, what's wrong with me? I'm a big damn dummy. I ought to just sell my bank and get out of banking. And there's a herd mentality that begins. But we have, the banks that survived this great crisis are tough, they're resilient, they're nimble, they're forward edge. And those that are questioning, I think most of the banks that are in the community banking space today will hang in. Of course, you're going to have consolidations where those make sense, but the greatest impediment are the regulations. And those regulations, we need to learn to scale regulations to size, risk, and complexity of the institution. That's what we need in this country. For community banks to flourish, for all banks to flourish, really, you need to scale those regulations to size, risk, and complexity. And then you can have a vibrant, forward-thinking system. But I would tell the guy to hang in there, because I think 5 years from now, and the landscape's going to be very conducive to a community bank in any given local area.
I think the challenge really is to get examiners to be able to examine at those different levels.
Correct.
And that's a big challenge for a lot of people in this room, but I know it can be done, and we've seen it done before.
Sure.
So it can be done. Karen, you've, throughout your career as an analyst, you've given lots of advice to banks. What do you tell your clients today about what the national regulatory landscape will look like in 5 or 10 years?
It really is a very different picture depending on the financial services firm, bank, non-bank, and also on the product mix. It's one of the reasons why I think you have to do it on a product line basis, because even though all of the numbers come back up to the top tier and turn into return on equity and dividends and all that great stuff from a shareholder perspective, the business mix really drives the regulatory framework. The only thing I think that is really important that cuts across it for the banks, and I wish it did for the non-banks, is this issue of internal controls, risk governance, and what the OCC has talked about, heightened expectations. It is really clear that boards of directors can't just get really cool 3-ring binders, flip through them when some fancy numbers go by on a whiteboard, and agree to things. They shouldn't have done that before, and I think increasingly they won't. That's true at community banks, it's true across the spectrum, and I think it would do the industry well to have that more generally applied so that governance really has some meaning and directors are far more independent as well as expert.
I'm fascinated by your functional model. Are you going to pursue this?
I'm sorry, what?
Your functional regulation model, your functional that you mentioned earlier about the shadow industries. Mm-hmm. Are you going to take on the mantle here and try to get the folks in D.C. to think this way?
I hope so.
Great.
Yeah. As I said, it's one thing we can do under current law, so I think it's really worth a good hard look.
Right. Sharon, I'm curious how what your biggest frustrations might have been as you developed this, as you're in the process of developing this unified system, and how much you looked at the American system as you were developing it.
Well, yes. I mean, sometimes I think it was helpful that there was a staggering of the way we did things. So, Dodd-Frank came out faster, partly because that's the way you do things, and you didn't have to go into it in as much depth as us. So that meant whilst we were doing our derivatives legislation, we already knew what was in Dodd-Frank, and we were able to have a lot of discussions, in particular with Gary Gensler, and so a lot of what we then got into our sort of first round, that was incorporating some of the rules he was going to make, engaged, and I think that, so it was kind of a bit of a nudge process. So that worked well. There were a few places where it didn't work, but basically it didn't work usually for deliberate reasons. In our case, there are a couple of things, well, quite a few things that I wanted and that the Parliament wanted, but the Commission had a different view. I think they now realise we were right. So I do wish that our trialogues, as they call them, like your conferences between the two parts, the House and the Senate, were televised, because I could point to it and say, told you so. But hopefully, one way or another, we will get there in the end. But I think the biggest frustration I find is that I think for things to work with getting the EU and the US together, I think we need to get intervention even at the pre-Basel stage and road test the rules on the markets, because our markets are different. And a lot of where we have made changes, and I plead guilty, I deliberately made some of them in CRD4, was because it didn't work. Now, I don't know quite what the European regulators at Basel were doing, other than sleeping or quarrelling or wondering about deferred tax. I don't think they were doing what I would want to do. Right. And we do have this problem and frustration, both in the UK and in the European Parliament, that we don't quite know what our regulators are saying in these meetings, because the normal course of things in democracy has been turned upside down. You normally have the political bit first and then the regulators. Now we've got the regulators doing it first, and then it comes for some kind of political sign-off. For us in Europe, that's always us. At both stages, both in the first stage of legislation, and then we can veto the rules if we don't like them. In the US, you have the first stage, which is again in Congress, and then you have the lawyers and the courts doing the second stage. But there's some kind of sign-off of what is done. And I'm not sure that this complete reversal without a little bit earlier political engagement, especially when you're into new areas, is going to work. And I will have another poke at things I'm a bit dissatisfied with. Well, not dissatisfied. I mean, I've got a lot of respect for central banks, but they're not immune from groupthink. Right. And at the moment, they're the ones that are calling the shots on everything. They're in the majority on all of the financial stability boards. And they don't have the full range of expertise across all of the markets and everything else. And as I said, they didn't necessarily cover themselves with glory in spotting the financial crisis either. So I just think we need to reclaim a little bit of territory back from the central banks.
Great. Okay, we're going to open up to the floor. Does anyone have any questions they'd like to ask at this point? Go ahead, sir.
My name is Robert Rose. I work for Brookline Bancorp, which is a $5 billion bank here in the Boston area. We think of ourselves as a large community bank.
You are large.
I think there are some, I agree with you, I'm a fan of community banks, but I think there are some dark clouds around our industry. In particular, I have some friends, banker friends in various parts of the country who say that they're having trouble making money. They're having trouble
making money.
Having trouble making money. Executive management is tired. The board is tired. They can't attract talent, young people, and they cannot afford to pay some of the experts they need in the world of compliance and things like that. And so when they go to put themselves up for sale or chat with other people, they find that the charter in some places just has no value. So I would ask you, the question is, What do you think would be one or two catalysts to sort of end that and turn that around? And number two, is there any danger of that creeping upward? Because I know that certainly even in the $5 to $10 billion size, bankers are struggling with those costs. Thank you.
Yeah, I think part of it is just generational change. I'm a baby boomer, and the baby boomers are beginning to shuffle off the stage, and you have a new generation coming up. So part of that tiredness is basically just generational fatigue. And a lot of times, particularly in the community bank space, the senior managements are a bunch of boomers. And they're all of a sudden what was, you look around a board table and it's nothing but white hair. And so there's just a certain amount of generational fatigue. And so they sort of talk amongst themselves, I'm tired, this is burdensome, it's not fun anymore, blah, blah, blah. I heard that when I was coming up from the people that had gray hair then. It's, I'm tired, it's not fun anymore, da-da-da. And I thought it was a ball, I liked it. But I was ready to go. So that's part of this. Another is the relationship between, and this gets a little in the weeds, but between the banker and the field examiners. I faced field examiners for 20 plus years. And honestly, the field examiners, and when I was, in the teeth of my banking career, had more flexibility to deal one-on-one with that banker and resolve issues in the bank without all of a sudden having to go either to the Kansas City District Office or the Federal Reserve Bank of Kansas City, or God forbid, to Washington, okay? They could handle it there in the bank. Everything wasn't a big deal. They could, I disagreed with my examiners a lot, but we could work it out. And they weren't on the phone talking to Kansas City or Washington, can I do this? Can I do this? So part of it is we need more flexibility in the system again. They've squeezed some of the common sense out, and that is showing up in the fatigue and the worry. And as far as not making as much money, it's harder. It's just harder. There's more competition, not necessarily from other banks, but from other providers, kind of the Apples and they're not in the teeth of it yet, but they will be. So it is tougher, and the rules, the regulations are making it tougher to make money. You used to have more flexibility. You used to be able to, banking at its heart is a relationship, common sense business. And I would make loans to people that today I wouldn't be able to make that loan. They were marginal, and I knew that probably I'd have a discussion with my field examiners, and I'd probably be able to talk them into a grace period, at least one exam or two, to see how the loan was doing before they hammered me on it. Today, I won't take that chance. Today, it's black and white. Either you're in the box or you're out of the box. And that's a shame, because that hurts the community banking model. But your bank, $5 billion, I think you're kind of in the sweet spot. That's a great little franchise to have. And I think you can do a lot with $5 billion. And you can be innovative, and you can out-hustle the competition in a lot of ways in a $5 billion bank. I think in a lot of ways, the smaller bank, it's not the too big to fail. I don't even like that term a lot. It's not those banks that keep community bankers up at night. They do just fine against those banks. I had a reporter one day ask me if community bankers were afraid of competition from the mega banks. And I said, are you kidding? I said, everybody's bigger than me. The credit union, the guy that operates out of the trunk of his car has more assets than I do. I compete against everybody. That doesn't bother me. What bothered me was, what kept me up at night was regulation, was how I was going to handle the check kite. I'll tell you another thing that increasingly toward the end of my career as a banker, before I transitioned to where I am today, was what we'd call today, we didn't call it really that in those days, is cybersecurity. I was terrified that my systems were going to get hacked, and somebody was, in a small bank, you can only take that loss once and you're done. And so that keeps you up at night. It wasn't the competition. But hang in there. A lot of it's generational change.
Next question.
Yeah, you mentioned 1,200 counties that have 1,200 monopoly community banks.
No, 1,200 counties that are only served by a community bank somewhere in that county. Now, it's, we have counties in Missouri that are bigger than the entire New England states. I mean, Vermont is like a county in Missouri. So think of it like that.
Okay. So, because I was wondering to what extent consumers are well served by having a lack of competition among banks. And then further, you mentioned not so much being concerned about competition from larger banks, but really from non-banks that are providing more cutting-edge services and products. And how hard is it for a community bank to do that? And how reliant are they on third-party vendors to make those services happen?
We're in the state of the great Tip O'Neill. And Tip has probably the most famous piece of political advice anywhere: all politics is local. You can apply that to community banking. All community banking is local. It really is community bank by community bank. To your question about the 1,200 counties, I wasn't saying there was only one community bank serving that county. I was saying there were only community banks serving that county, okay? So you could have 4 or 5 community banks in that county competing amongst themselves, but there are no mega banks, as we call them at ICBA, or actually any other types of service providers in some of those counties. So it's not that one bank is monopolizing that county like, say 6 banks monopolize the entire system. It is that one county might be served by 5 banks. As far as innovative products, community banks will do whatever it takes to get the innovative product. That's the part about all community bank is local. Some are heavily dependent on third-party service providers, like Jack Henry or Metavante, or the old Metavante, FIS, Fiserv, vendors like that. Some are big enough and have the scale. Some, Frost Bank has a lot of its own internal stuff. I consider them a community bank down in San Antonio. And so it just depends. That is a decision that each of those bank managements, when I was running my bank, I had to decide, was it more cost effective to go outside and get that service, or could I internalize it and do it myself? And I made that on a case-by-case basis. But whatever would help me in a competitive atmosphere, that's the direction I went.
Thank you.
Thank you. Another question?
Cam, the Federal Reserve distinguishes between community banks and larger banks when it comes to capital regulation, and allows smaller banks to not measure their capital adequacy under consolidated rules, but rather on a bank-only basis. I'm wondering if you think that distinction is appropriate, and that there should be a different approach to capital at the community bank level than at the large bank level, and whether the appropriate threshold for that distinction is the one that's now in effect.
Well, the threshold is very low right now. We've actually been pushing to make it higher. And I think you have to start from the premise that the average Tier 1 capital, the actual leverage cash capital, on average throughout the nation in community banking is just under 10%. Okay, that's Tier 1. I'm not talking risk-based capital. Risk-based capital, the average community bank on risk-based capital is around 15, 16%, somewhere in there. So you're starting from a very, very high capital ratio to begin with. So the small bank holding company exemption you're talking about, I think, is at what, 500 million and below? And that's only consolidated capital between the holding company and the bank. The bank still has to do to be well capitalized, the 6, 8, and 10. That doesn't relieve that small bank of that metric, the 6, 8, and 10, to be well capitalized. And believe me, it's not good to be under 6, 8, and 10, particularly in this environment where the bank regulatory agencies are actually requiring, in many cases, more than 6, 8, and 10 to be considered well capitalized, depending on the bank. Is it appropriate? I don't think there is an appropriateness to it given the capital structures of the small banks. I think if you're talking about banks under 500 million and whether they're under a different rule of consolidating their holding company capital to their subsidiary capital, I think any difference is pretty much de minimis in that area because they're already so highly capitalized that they're way off the charts compared to their bigger brethren, let's put it that way.
Any other questions? Paul?
I'd like I wonder if Karen and Cam could react a little bit to Sharon's point on how Europe looks at the shadow banking system and has really succeeded in shrinking it versus what we do here in the United States.
Go ahead, Karen.
I think it is as I said, I mean, it's much closer to regulation by function, although the comparison has to be done very carefully because, as Sharon said, the banking system is so fundamentally different. It's universal banks. The banks do things that are only relatively new in the United States, or only done in a few institutions. So, and the dangers in the financial systems are different from the different types of approaches. So the risks may be the same, but in terms of prudential risk, being highly leveraged is toxic no matter where it arises, or having inadequate liquidity. But the approach to doing it, the extent to which charter versus functional regulation works in each of the two venues, I think has to be nuanced by the structural and often cultural differences of the banking systems.
My only response to that, Paul, I think the European zone has done a good job of that, a better job than we have. And I have to say, because that's an opening to get a shot in here, that my biggest disappointment, I have a lot of disappointments with the CFPB, this is just my biggest one, okay, is that they're too much focused on the regulated banking industry and not enough focus on the unregulated, what we call the shadow banking industry. Their charter gives them all kinds of power over all kinds of non-commercial bank financial providers. And rather than spending all this ammunition on those of us that already have the OCC, the Federal Reserve, and the FDIC, and our auditors and everybody else crawling all over us, let's turn a little of that fire over to the non-bank sector. And that's my biggest disappointment. I think they're trying to get the low-hanging fruit and trying to put some notches on their pistol, and they got to grow up and be a regulator and know where the threats are and go after the threats rather than bludgeoning some $100 million bank in Sedalia, Missouri to death. Little editorial comment there.
I think we'll end it on that note. Thank you all very much. Con, we'll turn it over to you.